Bharat Bond ETF by Edelweiss Mutual Fund. You can now invest in AAA rated public sector bonds with just 1,000 rupees.
Namaste, Sat Sri Akal and Adab. Welcome to this show, Bond with Mr. Bond for Edelweiss Bharat Bond Fund. This is a one-stop shop solution for all investor needs. Let me explain to you the product first. As we all are aware, there are two asset classes, equity and debt. Edelweiss Bharat Bond Fund only invests in AAA rated PSU, public sector undertaking corporate bonds, which means it's a debt product. It will invest both in a 3-year option as well as in a 10-year option. Investors have a choice of investing through the exchange traded fund if they have a demat account. If not, they have a choice of investing through Edelweiss Mutual Fund through the fund of fund structure. Now let me introduce you to the guest on our show, Mr. Ashwini Dhawan, who's been in the hospitality industry for more than 35 years. Welcome, Ashwini.
Thank you.
Please let me know what is the question which you have on Edelweiss Bharat Bond Fund.
Thank you, Mr. Bond. You know, I have invested in the debt schemes in the past. While I agree that Edelweiss Bharat Bond scheme does not carry any liquidity risk, however, I'm wondering if investing in these long-term 10-year products will carry any interest rates risks or be more volatile.
Extremely valid question, Ashwini. Naturally, since it's a 10-year product, there will be interest rate volatility, as investors must be aware that there is a reverse correlation between interest rate movements and the net asset values of these bonds. If the interest rates go up, the underlying valuation of the bonds go down and vice versa. So naturally, when the interest rates go up, there will be some negative volatility as far as the investors are concerned. But as we say in equity funds, longer you stay invested, less the volatility. Similarly, if you stay invested in this product for a longer period of time, the interest rate volatility tends to even out.
So what should an investor do at such a juncture? Would the risk or the volatility not creep up? I mean, should the investor exit at this time or hold on to it?
Very good question. First and foremost, if you have invested in Edelweiss Bharat Bond Fund and all of a sudden post your investment, if the interest rates tend to go up, you treat it like a target maturity fund. You hold it till its maturity, which in the current context at this juncture is 10 years. The interest rate volatility will get evened out and you will get the captured yield less the expense ratio.
Okay.
On top of that, at certain junctures, if the interest rates have gone up, and if you have fresh money to invest, ideal thing is to invest further money in the product, capture that higher yield, hold it till its maturity, the residual maturity of that paper. It can be 7 years, 5 years, depending on when you are investing during this journey. And you will again get that captured higher yield at that point in time and less the expense ratio. So please treat it like an open-ended target maturity fund to start with. So to summarize for the viewers, after you invest in Edelweiss Bharat Bond Fund, if the interest rates go up, you have two options. Hold for longer periods of time till the interest rates movements get evened out or till its residual maturity. And two, if you have additional money, please invest at such junctures so that you capture higher yield and hold it till its maturity again. You will have better returns over your investments.
Thank you, Mr. Bond. Actually, no one explained that so simply and so beautifully. Thank you very much. Appreciate it.
Unfortunately, the investors tend to panic at such times and they try to exit. For those investors, this was a very valid question which Mr. Dhawan has asked us, and I hope I have been able to answer that query for the benefit of the viewers. Thank you. This is your host and host, Mr. Bond, signing off from Bond with Mr. Bond for Edelweiss Bharat Bond Fund. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.